Viva Las Vegas! Viva Las Vegas! Viva, viva Las Vegas! Hi guys, welcome to the episode number 13. I know you are confused if I'm Elvis. I'm not Elvis. What do you think about my how do you think I sing? Yeah, I know Elvis is a little bit better, but my name is Andres Vite. I'm a real estate agent with DXP Commercial. I don't sing, fortunately, and I just help investors to make the best investment on industrial assets here in the US. So this time for the episode number 13, I'm going to show you a very exciting market. Some people think this market is a little staggy. Yeah, maybe, but we are going to deep inside to know what if we can find a good deal there for industrial. Because I like staggy markets because that's where you can buy cheap, and that's what you want as a successful real estate investor. You want to buy cheap and sell high. Okay, so let me show you my CoStar software here. For those of you who is the first time you watch this show, this live, this is my CoStar, my property intelligence software. Its name is CoStar. It is the top or the leader on the property intelligence software out there. And as you can see, I can see market information for many markets all over the US, and I can even see some markets like Canada and also like the UK. For those that want to invest in assets in the UK, this is a good software to make a market research about the markets. So this time I'm going to show you Las Vegas. We had a contest last week about between Las Vegas and inland market in Los Angeles. For those who don't know about inland market, it's west to Los Angeles, and it's where most of the industrial assets are. So the winner for this contest, because I always make this contest in my LinkedIn account. You can follow me at the Nearshoring team. You can find my company name, and you can see every time I post and I will have a new live. I will post a contest between two cities or two markets, and this time it was for Inland Empire and Las Vegas, and Las Vegas was the winner. So let's deep dive into this exciting market. It's not all party in Las Vegas, it's also money. It's also investing and making money. So let me show you the market, for the information about the market here. I hope you please tell me if I have some audio problem. Okay, but I think everything is running okay. So let's see the information about this market in the CoStar software. So as we can see this at the top of the website or the page. We can see this information like a summary, like KPIs, key performance indicator for this market. So we can pretty much get a fast idea about how the market is going on, it's behaving. So for example, here we have the inventory on industrial assets, because this is only for industrial market. You can also find other markets hidden in CoStar, like multifamily, even healthcare, or those kind of markets, hospitality, retail, office. But since I'm specialized on industrial, we are gonna take a look on the industrial market in Las Vegas. Okay, so inventory this last year was almost 200 million square feet. It went up from the last year, which was about 4% up. Okay, so if the inventory goes up, maybe the market it's not that good because you have not you are not absorbing those extra square feet, you know. So, but maybe you have to figure out, you have to find more information. Okay, so under construction, okay, under construction went down. Okay, went down almost 50% from the last year. So we are starting to doubt about if this market is going well or it's going bad. So probably it's not that good, but later I will tell you the reason. It's not, don't be afraid, guys. I will tell you the reason and how to make money, which is the most important thing. Okay, so net absorption, also net absorption going down. That's a bad thing because that means we are lacking demand. Okay, vacancy rate, excuse me, it went up, but just 1.4%. It's not that bad, guys. It's not that bad. Vacancy just 1%. It's all the US is the same situation, you know, even worse than that. So market rent, this is a good sign because market rents, current market rent, $14 per square feet. Let me tell you something, guys. It's almost the same like as in inland market in California. Vegas, I think it's 3-4 hours away from Los Angeles. So, of course, it's Nevada, it's another state, but it's almost the same price, okay? But I know the market is Los Angeles. It's a huge market because Las Vegas, it's a small market and mostly hospitality. But Las Vegas, it's like a hub for Los Angeles, you know, to serve Los Angeles, to serve the West Coast mostly. So rents are very similar. So what's the difference? Difference are the taxes, guys. Guys, for those of you who live in California, you know, California taxing, it's really bad, guys. Okay, so many people are moving from California to Nevada, actually, and they also have, the state of Nevada has also many tax, you know, how you call this, you know, the tax rebates, like tax rebates in property taxes or sale tax for these companies to move in, you know. I'm not pretty sure, but I think Nevada is one of those states that has no state income tax. I have to double check, or you guys, if you know, leave on the comments. But I think it has no state tax. Okay, so that's one. That's why you have you may have similar rents and actually be more competitive than California. Okay, so rents only went up only 0.5%. Okay, from last year. Sale price, it's high for this market. I guess it's because most of the transactions for this market that Class A assets, you know, so Class A assets are new assets. So if you have new assets, you have a higher price because those properties are newer. You don't have to deal with a lot of maintenance, you know. So that's what well, you may like or you may not like. If you are a buyer, maybe you don't like that much. It has a really, really low cap rate. So that means if you buy, it will cost you more, you know, that property. So as an investor, it's not that good as a good deal. But if you are selling, that's a good deal because you get more money for your investment. You know, the lower the cap rate, the more money you receive when you sell. Okay. So now I'm gonna tell you why this market is staggering. Probably most of you already know, but right now, the economy in the U.S. is not going um, that well like 2 years ago. So the weakest part of the economy or the weakest industry of the economy is most of the times tourism or hospitality. Okay, so what's the first time you stop doing uh, when you have higher prices and you have to to pay more for food, or maybe to pay more for rent or other things, or maybe you lost your job. So the first thing in the economy that goes down, it's hospitality. So Las Vegas, it's a hospitality, it's a tourist center. So many of these industrial inventory are for hospitality industries. For those hotels, they probably are warehouse for those hotels, serving those hotels, those restaurants. Okay, so that's why we are seeing bad numbers here. But Las Vegas, it's not only hospitality. It's not all party in Las Vegas, because you are just 4 hours away from Los Angeles. And here's the interesting thing. If you What's the last thing that everyone is watching right now in the news? The closure of the Strait of Hormuz. So the closure of the Strait of Hormuz, it's where most of or big part of the oil, of the worldwide oil trade, they travel through the Strait of Hormuz. Okay, so right now it's closed, by Iran. So prices, if you see, prices of oil have been going up. So that means we may see tensions between China and the U.S. getting worse, because China needs that oil. China needs that oil. And probably we may see the tensions arise between the U.S. and China, because China thinks the U.S. is doing this to affect China. Okay, so we may see less trade between China, and actually we will see less trade because of the rising prices of the oil, but also because of the rising tensions between China and the U.S. So that means in the long term, mid or long term, we may see more companies moving from China either to the south of the U.S., okay, or to Mexico, okay? And one of the states or the parts of the U.S. That receive most of these imports from China, it's the West Coast, okay? So, for example, in the West Coast, we have we have this market for medical devices, we say, for medical devices, and all these electronics, all these chips and electronics, they import through the West Coast, okay? So we may see an increase on imports from these big China companies, and maybe some manufacturing these chips or electronic devices, medical devices, either in the south of the U.S., in the West Coast, south of the U.S., maybe Los Angeles, Phoenix, Las Vegas, or maybe even in Mexico, like Tijuana or Mexicali. Okay, so for example, Tijuana, it's just 5 hours from Las Vegas. Okay, so that's where we are. These kind of tenants are those who we are betting to purchase and to make an investment here. So even though the hospitality industry in Las Vegas went down from 2 years ago, this is not recent. It's coming from COVID. Okay, so even if it went down and affected all these numbers, we are expecting the imports from China or maybe the manufacturing from China to move to the US or to Mexico. And even if it's moving to Mexico, they need a warehouse close to the market. And the market, it's Los Angeles, it's the West Coast. Okay, so that's what our strategy will be about. So let me show some more numbers just to make stronger this theory or this hypothesis. For example, we can see, let me show you, sublet, months of market. Months of market, 5.2, it's a good number. Demand, 6 months, leasing probability, 50%. It's in line with national average is 46%. Okay, let me show you rent. For example, if we see the rent national, it's $12 per square feet annual, and here in Las Vegas we see $14 per square feet. Okay, actually it's because it's very close to Los Angeles, and in Los Angeles it's where the rents are more expensive. Okay, so sale transactions, let me show you demand, market asking rent growth, 0.5%. The rent is growing, even if it's if you may think it's not a good market. The rent is growing half point percent. Okay, cap rate, it's a good cap rate. Okay, I see. Actually, we all in this timeline we can see the highest cap rate was almost 10 years ago, 2017. Okay, 6%, and the lowest it was 2021, 5%. So it's a market very, I guess, maybe the demand was very high, or maybe they have very new assets, new inventory. That's why they have this compressed, this low cap rate. Okay, what we can see here, it's we can see another thing here. We see most of the inventory here, it's new inventory. Okay, and it's new inventory, and it's larger than 250,000 square feet. Okay, so these developers that were developing that were building these new buildings, they were struggling to rent it out, okay, to one tenant, because if you want to rent a space for that it's 250,000 square feet for one tenant, it either has to be some big logistics company like Amazon or big manufacturing company. Okay, so manufacturing, I guess these Chinese companies that are moving to the US or from China to the US or Mexico, they prefer to manufacture in Mexico. Okay, it is what it is. They go to where the cheapest labor is. Okay, so we take out those manufacturers from the equation, and then we stay with the logistics. So the logistics, they are probably choosing this big market like Amazon, big logistics companies like Amazon. They are probably choosing California, okay, because they want to be the closest to the market, and they are probably not paying too much taxes because they are only using for a warehouse. They are not manufacturing, okay? So what these people, these developers are doing to rent out these spaces they are subdividing these spaces. They are saying, okay, we cannot rent to one tenant, we have to subdivide, okay? So this makes sense, because if you subdivide a building for 250,000, you probably subdivide into 50,000 spaces, let's say. So that's a perfect space for these Chinese companies that are just importing, because remember, these are tier 2 companies, okay? This is not like big assembly companies, like they manufacture cars or things like that. They just make pieces. They make pieces of things, maybe a battery, let's say a battery. They make batteries, and they want some warehouse to store their inventory, because they sell that pieces or that products to other bigger companies, maybe Tesla, okay? Maybe Tesla, maybe Ford, maybe Toyota, I don't know, but these are tier 2 companies. These are called tier 2 companies, because they are not they are not assembly companies like Toyota or like these big car manufacturing companies, okay? So for this kind of tenants, 50,000 K, it's more than enough, because they don't want to in their numbers, in their cash flow, having stock, it's not good for a business. They try to minimize the stock, okay? So if they are producing, they are making batteries, or they are making electronics, or anything they produce, they make, they just want the minimum inventory to store, but they need it, okay? So what we are going to do is we are trying to locate these new spaces, like class A spaces, okay, that are vacant, and we are subdividing and renting out to those Chinese companies importing parts for other tier 1 companies, okay? So net absorption, let's see, you can see the vacancy. It will be according to CoStar. It has this forecast. Usually I don't take the forecast as as mandatory, but it helps, but it's not like the last word, okay? So, but they say vacancy, it's dropping from 2026, which is in line with the national forecasts for the US market. And also I believe that, because I believe from this year, and mostly from the end of this year and the beginning of the next year, we are starting to see reduction on the Federal Reserve rates, and we are seeing vacancies, lowering vacancies and lowering cap rates, okay? So net absorption, leasing activity. Let me see, show you actual leasing, vacancy rate. Let me see, net absorption. Vacancy rate. Okay, logistics, specialized. Okay. Availability, vacancy market, asking rent growing, months of market, stable, months to lease, stable. Well, rising a little bit from 25. I have no forecast here. Months vacant, sitting vacant, probability of leasing in months, 3.4 months. It's a good number. Okay. Asking rent growth year over year. We are in line with the, let me see, logistics, Las Vegas, almost zero in the 2026, 2027, growing 3.7% and stable at that after 2027. So goes in line with the forecast for the US market. We are, as I've told you guys in previous episodes, we are in the deep right now in 2026. So it's time to buy. It's time to buy, and 2027 or at the end of 2026, we're starting to see some growth, some cap rates compressing, some rents growing, and the economy going better. 2026 it's not an easy year for the economy. Lots of things going on, lots of things. Okay, market asking rent, construction starts. You see, construction, they stopped building new assets in 2025. You know, they build and then they realized this contraction on the economy and they stopped building new deliveries. You see the drop here on the deliveries. Okay, under construction also stopping, probably growing again from this year or from the next year. Okay, because developers want to see some kind of movement on the economy before they start building again, you know. Okay, market cap rate stable. What I like of this market, it's very stable. It's very stable cap rate. Okay, the economy we see, for example, here, you see what I told you, leisure and hospitality 2.5. I guess it's million employments. Yeah, it's million. Okay. Oh no, this is 300 and 300,000 employees. Is the biggest employer. Okay, then trade, transportation and utilities is the second largest employer. Retail, it's also a big one. Okay, unemployment rate, change, median household income. Okay, we don't mind too much about this, the income, because we are a logistics serving the West Coast. We are not serving this market, so probably important for manufacturing companies maybe, but most logistics companies or these tier 2 companies, they don't have many people hired on those warehouses, you know, so they don't mind too much on that number. Population, okay, origination. Let me show you sellers. Okay, sale by buyer type and by seller type. So most sellers are private, okay, private and institutional, okay. So let's find out some properties for this strategy. So we are looking, summary again, we are looking for class A assets, 250K and more and bigger, because these are the assets that has the more vacancies right now, okay, because they are trying to lease it to one tenant. What we are going to do is we are going to throw a low ball, we are going to purchase that space, and then we are going to subdivide and market to these Chinese companies, probably Chinese companies that are either moving or that are from China moving to the US, or are already in the US and are expanding, are growing their operations because they see these tensions between the US and China growing up, and they are investing more, taking more imports from China. Okay, so let's find those properties. So for that, we go to the sales part of, we can also click this part, properties, you see, and we can choose for sale, for sale, and then the property types. But I like this sales section because I think it's the same thing, guys, but I just like it more because I think it's more specialized, but that's a thing for me, but it's the same thing. Okay, so Las Vegas. The difference is here in properties, you can see properties that are either for sale, for lease, or out of the market, off market. Okay, so if you want to go and find the owner of that property that it's off market, you may go to this section. Okay, but for this, we go to sales and find for sales properties. And then we go to industrial directly. We are not looking for flex because you already know, guys. If you watch me, I hope you watch me. I have also, for those who are watching me on YouTube, on LinkedIn, or are watching me on Facebook, I have a channel on YouTube. You can find me as Andres Vite, or you can type the Nearshoring team, and you will find me. I'm with a helmet, so you will find me. And subscribe to my channel, and I have more information. I have classes every week there, so you can learn more about this, why I make this decision. If you find it nonsense, maybe you will you need to go to my channel and find those classes. Okay, so we look for industrial, and where we are going to filter up the size. Remember, we are looking to, according to the market report, we are 250 and up. It's where the most vacancies are. Okay, they are struggling to sell those assets. Okay, and they also say that this is where the most new developers are, the 15th highway. And that makes sense, but because 15th highway goes all through to Los Angeles, okay? And from Los Angeles, you can go to Mexico, all the way to Mexico, okay? So we want to be close to the 15th, Okay, so we have here 14 properties for sale. Okay, so we have here, and here. Let me see if okay, I'm going to filter up Class A properties. There's two ways to filter up Class A properties here. One way is you go to this section, building, and then click this Class A. So you end up with 4 properties. But you can also use this coastal rating with what I like more than Class A. They say it's more exact, So Class A, it's probably 4 and 5 stars. So you see, it's the same thing, 4 properties. Okay, so we are looking for this. We end up with 4 properties. Let me see what other filters. So we are looking for new properties, Class A, 250K and up and over. Industrial, we are not looking for flex, because flex it's mostly for the local market. These are service companies, these are service tenants, like construction, like business services, like cleaning or something like that, like landscape companies, but industrial, it's more like warehouses, like logistics, like manufacturing, those kind of big guys. Okay, so we have 4 properties. Let me see if I can filter up from 200 and over, maybe. We have 6 properties. Okay, let's filter for 200,000 and over. And we have 6 properties here, Class A properties. So these properties are probably sitting vacant. Okay, we can confirm that. If we want to be sure that they are sitting vacant, let me see. Tenants. We go to this part. Where is it? No, I don't think it is. Oh, I guess I have to click this one. Okay. Because I can see the. Let me see. Maybe I can find it. Maybe I'm doing something wrong. Exclusions. Existing, abolished, tenancy, single, multiple, days on market, cap rate. Percentage listed. Okay, so we want to be sure those properties are sitting vacant. Let's say minimum vacant or maximum vacant, it's 30%. So that means only 1/3 of that building is listed up. Okay, so 3 for sale, 4 properties. Okay, so these are the only 3 properties we have. So these properties are mostly sitting vacant. As you can see, this one, it's 1,000, it's 3 years of the market. Okay, let me see, not disclosed, last updated. Okay, wow, this is very big. This is very big property. Okay. Okay. So here we are with 3 properties, guys. Okay. So we have this first property. It's sitting 3 years on the market. It's 664,000 square feet distribution building. Okay. So price, it's not disclosed. We're gonna find out how much are we going to pay for this one. And the second option, it's I think maybe this is a portfolio property because it's 4 property. Maybe it's only 4 buildings, but it's, it's kind of the same thing. Okay, it's yours in 4 lots instead of 1 lot. But this one is 352,000 square feet, sitting vacant for almost 2 years. Okay, and this last one, it's 227 square feet, built 2025. Okay, and again, almost 2 years on the market. Well, it's 1.5 years, let's say, on the market. This one. Okay, let me see this one. Let me see this one. Okay, guys. So we have these 3 options. Option 1, Terrell B. Adams Street. Option 2, the Commerce Center. And option 3, Craig Road. So I'm gonna give you 1 minute to vote for which one you want me to analyze, and we are going to find which price we should pay for that property. Let's imagine we are millionaires and we are paying for this property. Like, I don't know how much it will cost, but it will cost a lot. Okay, so first one, Terrell Adams Street, the second one, Commerce Center Street, and the third one, Craig Road. Which one do you want me to analyze? So let's start the poll, and you can comment on LinkedIn or either in YouTube. You can comment which one you want me to analyze. So I will wait for you. Okay. Okay, so again, option 1, Terrell Adams Street, 664,000 square feet, built 2024, sitting vacant almost 3 years. Second option, Commerce Center, 352,000 square feet, sitting vacant for almost 2 years. And the last one, it's Craig Road, sitting vacant 1.5 years, 227,000 square feet. Okay, so which one you want me to all 3 properties are on the 15 highway corridor. Okay. Okay. Let me see some pictures. Okay. Which one do you want me? Which one would you choose, guys? This one looks good. It has an office. It's so huge, this one. I don't know why they build some huge building here. It's too much risk, guys. These guys had to have a lot of money. Okay, I think it's no. Okay. Okay. So someone says here, I think the winner it's Terrell Adams Street. So we are going. This is the one with most time on the market. Huge building, huge, guys. Huge. It's a huge building. Let me show you. Can you see the pictures, guys? It's a very pretty building. I like it. I like this building. Oh, this has a 3D. Let me see. Guys, this is massive, guys. This is like for something like Boeing or something like that. Like, you can make like a jumbo jet here. You see how many doors it has? What the hell? I think if you subdivide this thing, you should put a wall all over here and then put walls all the way parallel to those, to perpendicular to that wall, so you maybe can subdivide in, I don't know, guys. You chose this one, but it's just too much for risk for me, because, but anyway, let's see how much can we pay for this one. See, that's the pro of purchasing new buildings. You see, you have new roof, you have new areas, pavement, lots, everything. It's new, the drainage, so you don't have to deal with those repairs and maintenance. Even when you have a triple net lease that the tenant pays for everything, the rent plus the maintenance, the insurance, what's the other thing? I forgot, but they pay for everything. Okay, maintenance, insurance, taxes, property taxes. Yeah, but you will get higher rents here, because they don't have to pay for too much maintenance and things like that. They have a space for office. You see? Wow. Massive building, guys. You see the size of that door? Wow. You can take a ship through there. Wow, and sitting vacant 3 years. You know what's the worst thing of this? I've had clients that have these kind of massive buildings sitting vacant for maybe 3-5 years, and the bad thing about that is those buildings start to deteriorate if they sit vacant too long, and they don't have the properly maintenance. They start to deteriorate, so you have to run some kind of inspection there. Okay, so how much would you pay for this? Let's just make some fast calculations here. How many doors does it have? Total drive-ins, 4 total. 123 doors, guys. Docks. It has docks, not doors. It has no ramps. Only 4 ramps, actually, because this is more for logistics. Like it's not like last mile logistics, but more like actually to serve other markets like Los Angeles, as I told you. Actually, public record, 18 million assets value. Of course, the assets value is not the same as the market value most of the times. But let's say if we have 100, let's say how many doors? I'm gonna find out how many doors, how many, let's say if we divide, we should have to divide maybe 100K. No, 100K, it's too much. 50K, let's say if we divide 664,000 divided by 50,000, we have 13 spaces. 13 spaces. So if we have 13 spaces and we have 100, it's so many doors. Why 100? Are you sure you have 123 doors? It's too much, guys. Let me double check here at the I'm watching the flyer. You can see because I'm not sharing that screen, but let me just find how many doors it has. The baseball. Well, it says here the divisible 160,000. $160,000. It has a clear height 40 feet. Wow, it's basic. 123 dog high doors. Okay. So here it says let me show you this. I don't want you to be blind here. Let me show you. Replace. Where is okay? I'm gonna show you this document I'm watching. So otherwise you will leave. I know you guys. Okay. This is the flyer from the seller agent, which is CBRE. So here we can see divisible to 160,000. Okay, why they say that? Because probably because of the doors or the the meters. They have probably those that amount of meters. So I usually say we can divide by the doors, but that's not always the case because you have to take into account the utilities, the meters, the water, and everything. So this is in this flyer, the seller says that it's divisible up to 160,000. Okay, so that's what we are going to do. Spacing 50 by 50, clear height 40. Okay, so 160,000, it's easier to rent than for sure than 660,000. It will be easier, but it's harder to rent than 50,000. Okay, but let's do what the seller said, that it's divisible up to 160. So we divide 660 by 660,000 divided by 160,000, and we have 4 spaces. We can divide it on up to 4 spaces here, and of course we can increase the rent because as I've told you before in other episodes, the smaller the space, the higher the rent you can charge. Okay, so estimated rent here for the whole building, 10 to 12. I think it will be more because it's brand new, because it's sit vacant 3 years, they probably CoStar probably punish the price of the lease. But let me see some analytics here. Analytics. Las Vegas, 40. So let's say we rent it out for $15 per square feet. Okay. So we rent it out for $15 per square feet once we subdivide. Oh, shit. What I did. Okay. Oh, I'm still showing the document. Let me change my screen. Okay. Okay, I think we are good now. Okay, so let's say we are renting for $15. So we multiply, again, this is fast numbers. This is not what you should, the way you should do the things to calculate the price for, to pay for a property. You have to, you have to calculate the present value of the cash flow of rents, but this is a quick way to calculate it. Okay, so 664,000, okay, divided, well, no, oh, excuse me, 664,300 by, we say 15, so we have almost 10 million a year. Okay, so we have 9 million, 9 million and $964,500 a year. So we divided, let's see the analytics again. Vacancy rate. Let's put 10% vacancy here. So we multiply this by 0.9. So we end up with 9 million annual rents. And this is, since this is triple net, most of it's profit. So this is, I will not calculate all the costs and everything. You have some other costs other than the triple net, but I'm not gonna calculate that. Most of this rent will be triple net for the purpose of this live. Most of it will be NOI. Okay, so 9 million. And what's the cap rate? 3-star. 3 to 5 star. So cap rate, sales, analytics, sales. Cap rate 6.88%. Okay. So we are since we need time to rent out this thing, we are having it backend probably more than a year, actually, because we are subdividing into 6 spaces, and then we are taking more than a year probably to rent it out the full space. So we are not paying the 6% cap rate. We will be offering the seller a 9%. We are throwing a low ball. Okay, so we divide this effective rent by 9%. Okay, and if we divide by 9% cap rate, we will pay around $100 million. Okay, again, this is a property that it's giving us $9 million a year. Okay, so that's why it costs so much, But since we are paying for a cap rate, let me show you what we'll be paying if we pay that 6% cap rate. We will be paying $150 million. So we are saving $50 million. And if this information is correct, and we rent it out, okay, and we can sell it for a 6% cap rate, we are going to be profiting $50 million. Okay, maybe we need 3 years to rent it out, have some cash flowing statements, show them to the bank, show them to the seller, to the buyer, to the next buyer, and probably in 3 years the economy will be better and they will be paying that amount of money. Again, this is fast calculation, this is happy numbers. We may probably have it more time sitting vacant, so it's a high risk building. I will not do it. I will not purchase a property that big because it's too much risk. I would prefer to purchase a 250,000 building, and then subdivide it into 50,000 spaces, and then sell it out. I think 50,000, it's a good space for this kind of tenants we are looking for. But 150, I think it will be hard to rent that space, or we may have to give some concessions and then less profit for that, or maybe less rent. So that means less profit, and less profit means less sale value, okay, and less money for us. Okay, so this was the I think we reached the end point of this live. So I hope you like it, guys. Again, if you want to see more videos like how this thing, because this is 1 hour live, so I cannot explain everything. I cannot run like a spreadsheet about this. We're just doing some fast calculations, but I have a YouTube channel where you can I upload weekly. I upload at least one video of a class explaining how to purchase, how to invest in commercial real estate. So the name of the channel, you can find it on YouTube as the Nearshoring team, and subscribe and you will get updated. Also, I have an investor club. If you are really interested in investing in commercial real estate, you can join my investor club. I will leave you with the link on the description, or you can visit my website. It's www.thenearshoringguy.com, and then you click on the investor club, and in that investor club, if you join, you will receive in your email every deal I find all through the US, every industrial building I find, every investment opportunity, and you can invest from $20,000. I syndicate the properties, or maybe you can. I also send my investors properties that they can purchase for themselves without syndication. Okay, so hope you like this video. Give it a thumbs up, give it a like, subscribe. Don't forget to subscribe to my YouTube channel, and see you on the next one. Thank you.